Morgan Stanley and Goldman Sachs have both issued cautionary notes regarding the current boom in artificial intelligence (AI) investments, highlighting potential risks and market dynamics. Morgan Stanley warns that the AI boom, which has significantly driven S&P 500 returns since the introduction of ChatGPT in November 2022, may be losing momentum. The S&P 500 unpack AI Sentiment Index has only risen by 6% this year, compared to the broader S&P 500 index's 14.2% growth, indicating a cooling enthusiasm for AI stocks. Contributing factors to this potential slowdown include negative free cash flow growth for AI hyperscalers, rising pricing pressures, and speculative risks reminiscent of past tech cycles. As a result, Morgan Stanley advises investors to be cautious, particularly with small-cap and unprofitable tech stocks, and to consider reallocating portfolios towards more stable assets like gold, real estate investment trusts, rights and commodities. Goldman Sachs CEO David Solomon also predicts a potential market drawdown within the next 12 to 24 months, likening the current AI investment surge to past tech cycles such as the dot-com era. He notes that while AI offers transformative potential, investors may be underestimating the risks, which could lead to increased volatility and a revaluation of AI-driven stocks. Despite these warnings, Solomon remains optimistic about long-term economic growth, driven by aggressive fiscal policies and infrastructure investments, with expectations of a robust year for mergers and acquisitions in 2026. Both firms emphasize the need for a more strategic and selective approach to AI investments, focusing on companies that demonstrate tangible returns and long-term value as the market transitions from rapid expansion to a more sustainable growth phase.
Emera Incorporated has successfully closed an offering of $750 million in fixed-to-fixed reset-rate junior subordinated notes, set to mature in 2056. The notes, which carry a 6.25% interest rate, were issued by EUSHI Finance, Inc., a subsidiary wholly owned by Emera, and are fully guaranteed by both Emera and its U.S. holding company, USHI. Major financial institutions, including Wells Fargo Securities, J.P. Morgan, and Morgan Stanley, acted as joint book-running managers for this substantial financial undertaking. This move is part of Emera's broader strategy to manage its capital efficiently, with the proceeds earmarked for general corporate purposes, such as repaying existing debt. The issuance of these junior subordinated notes reflects a strategic financial maneuver designed to bolster Emera's capital structure. Junior subordinated notes are a form of debt that ranks below other debts in terms of claims on assets or earnings, often used by companies to raise capital while maintaining flexibility in their balance sheets. The fixed-to-fixed reset rate feature of these notes means that after an initial fixed rate period, the interest rate will reset at predetermined intervals, which can be advantageous in varying interest rate environments. The successful placement of these notes underscores investor confidence in Emera's financial health and strategic direction, potentially impacting the company's credit profile and future borrowing costs.
Polymarket, a notable prediction platform, is set to relaunch in the U.S. after receiving regulatory clearance from the Commodity Futures Trading Commission, CFTC. This move comes nearly 4 years after the platform was forced to suspend its U.S. operations due to regulatory issues. The CFTC's no-action letter, addressing previous reporting and record-keeping violations, effectively clears the way for Polymarket's return. This development is significant for the broader prediction market sector, as it may encourage other companies operating in the gray market to seek official certification and legitimacy. The relaunch of Polymarket is poised to test the viability of prediction markets under U.S. regulations, amid ongoing controversies and legal challenges. The platform, which allows users to trade shares tied to real-world event outcomes, gained popularity during the 2024 U.S. presidential elections despite its absence in the U.S. market. As Polymarket prepares to resume operations, it is pursuing a new funding round valuing the company at $9 billion, with backing from 1789 Capital. The relaunch coincides with increased scrutiny of prediction platforms, presenting an opportunity for Polymarket to establish itself as a legitimate forecasting tool in various sectors, including finance and policymaking.
Shares of Ondas Holdings, NASDAQ. ONS surged 26% to $9.21 following the company's announcement of an initial order of 500 Wasp drones from Rift Dynamics. This move is part of Ondas' strategy to penetrate the U.S. defense market through its subsidiary, American Robotics. Ondas, which has a strategic investment in Rift Dynamics, is leveraging Rift's NDAA-compliant drone designs and Kitron's manufacturing capabilities to meet the U.S. Department of War's demand for affordable, attritable drone systems. The Wasp drones are designed for combat and perimeter defense, and with U.S. distribution rights secured, Ondas aims to capitalize on the Department of War's procurement programs. The stock's dramatic rise is attributed to growing investor confidence in Ondas' market potential, particularly after its recent inclusion in the S&P Global BMI Index and the appointment of Brigadier General Patrick Houston to its advisory board. The company also secured a $3.5 million order for Apero's unmanned ground vehicles, further enhancing its defense technology portfolio. Analysts suggest that Ondas is still in the early stages of its growth cycle, with a large addressable market and potential for upward revisions in earnings. However, they caution that rising operational costs and potential deployment delays could temper investor enthusiasm. Despite these risks, the stock's performance indicates strong market confidence in Ondas' strategic direction and growth prospects.
Intel's stock has experienced a significant surge, rising over 54% in the past month. Following a strategic investment by the U.S. government and a $5 billion commitment from NVIDIA to co-develop AI chips, the U.S. government acquired a 10% stake in Intel for $11.1 billion in August, which has now appreciated to approximately $16 billion, marking a 50% increase. This rally has been further fueled by reports of potential collaboration with Advanced Micro Devices, AMD, suggesting Intel's manufacturing unit might add AMD as a foundry customer. These developments have been positively received, with the White House acknowledging the investment's success. The U.S. government's investment in Intel was facilitated by reallocating funds from the CHIPS and Science Act and the Secure Enclave program, emphasizing a strategic focus on bolstering domestic semiconductor manufacturing. Intel's CEO, Lip-Bu Tan, highlighted the importance of maintaining advanced technology production within the U.S., aligning with national economic and security interests. Despite the current optimism, some analysts, like Bernstein, remain cautious, maintaining a market perform rating on Intel due to its historical volatility and fundamental challenges, suggesting potential future fluctuations in the stock price.
Citadel Advisors, led by Kenneth Griffin, has made significant investments in the AI and quantum computing sectors, purchasing a total of 18 million shares worth $170 million. The hedge fund acquired over 14.9 million shares of Resolve AI, a company specializing in AI-powered commerce solutions, and 3.4 million shares of Quantum Computing, a firm focused on quantum communications technology. These investments follow a surge in the stock prices of both companies, with Resolve AI's stock climbing 71% and Quantum Computing's rising 32.7% over the past month. Resolve AI's impressive performance is underscored by a 426% year-over-year increase in H1 revenue, reaching $6.3 million, and an annual recurring revenue of over $90 million. The company has raised its 2025 ARR exit rate target to at least $150 million, highlighting strong demand for its BrainSuite technology, which facilitates agentic commerce. Meanwhile, Quantum Computing is advancing with its quantum secure solution aimed at enhancing data security and scalability in quantum communications. The firm recently raised $500 million through an oversubscribed share offering to accelerate its commercialization efforts and strategic growth initiatives. These developments indicate Citadel's strategic positioning in cutting-edge technologies poised for substantial growth.
Asset Advisors Investment Management LLC has slightly reduced its position in the iShares Select Dividend ETF, NASDAQ, DVY, trimming its holdings by 0.7% during the second quarter, according to a recent SEC filing. Despite this reduction, the fund still maintains a significant investment, holding 64,918 shares valued at approximately $8.62 million, This move is part of a broader trend among institutional investors, with entities like Wealth Enhancement Advisory Services LLC and Bessemer Group Inc. increasing their stakes in DVY, indicating continued interest in dividend-focused equity investments. The iShares Select Dividend ETF, which tracks the Dow Jones U.S. Select Dividend Index, has shown solid performance, with its stock trading at $141.99, close to its 52-week high of $144.09. The ETF boasts a market cap of $20.82 billion and offers a dividend yield of 3.5%, following a recent increase in its quarterly payout to $1.2465 per share. This ETF is popular among investors seeking stable income through high dividend-yielding stocks, reflected in its consistent performance metrics, including a price-to-earnings ratio of 13.69 and a beta of 0.87, indicating lower volatility compared to the broader market.
Warren Buffett's Berkshire Hathaway has announced a significant acquisition, purchasing Occidental Petroleum's petrochemical unit, OxyChem, for $9.7 billion in cash. This strategic move comes as Berkshire sits on a substantial $344 billion cash reserve. The acquisition aims to mitigate losses from Berkshire's common stock position in Occidental, which has been under pressure since the ill-timed Anadarko Petroleum acquisition in 2019. This deal allows Occidental to reduce its debt by $6.5 billion and cut interest payments by nearly 30%, thereby improving its financial health and enabling stock buybacks. Occidental's CEO, Vicki Hollub, emphasized that the transaction resolves a key financial issue and positions the company to capitalize on its oil and gas resources. The acquisition is expected to have a dual impact. For Occidental, it simplifies the company's operations, focusing on its core oil and gas business while bolstering its balance sheet. This financial restructuring could make Occidental a more attractive takeover target in the future. For Berkshire Hathaway, acquiring OxyChem provides a robust portfolio of assets, potentially offsetting losses from its common stock holdings in Occidental. Additionally, Occidental's commitment to redeem Berkshire's preferred stock by 2029 as its cash position grows further solidifies the financial benefits of the deal for both parties. This transaction highlights Buffett's strategic approach to leveraging Berkshire's cash reserves for long-term gains despite short-term setbacks in its equity investments.
Exchange Capital Management Inc. has reduced its holdings in the Schwab U.S. Large Cap ETF, NYSEARCASCHX, by 10% during the second quarter, as disclosed in its recent SEC filing. The firm now holds 151,666 shares valued at approximately $3.7 million. The Schwab U.S. Large Cap ETF, which aims to track the Dow Jones U.S. Large Cap Total Stock Market Index, has seen its stock price range between $19 and $26.54 over the past year, with a current market capitalization of $60.84 billion. The movement by Exchange Capital Management is part of a broader trend among institutional investors adjusting their positions in SCHX. Notably, other firms such as Harbor Investment Advisory LLC and Cruise Bank and Trust have initiated new stakes in the ETF, indicating ongoing interest in large-cap U.S. equities. The ETF's performance, with a P/E ratio of 25.66 and a beta of 1.01, suggests moderate volatility compared to the broader market, making it a significant player for those seeking exposure to large-cap stocks. This adjustment in holdings may reflect strategic reallocations by institutional investors in response to market conditions or changes in investment strategies.
Hilltop National Bank has made a significant investment in Southern Company, NYSE, acquiring 28,833 shares valued at approximately $2.65 million during the second quarter, as per the latest 13F SEC filings. Southern Company, a major utilities provider, has seen varied interest from institutional investors, with firms like Investment Planning Advisors, Inc., Triad Wealth Partners, LLC, and Murray Asset Global Investments Co., Limited also increasing their stakes. Institutional ownership now stands at 64.10%, indicating strong institutional confidence in Southern's market position. The stock has been the subject of mixed analyst reviews, with a consensus rating of hold and a target price of $95.08, reflecting a cautious yet optimistic outlook. Southern's recent financial performance has been robust, despite a slight miss in its Q2 earnings per share, EPS, of 91 cents against the expected 99 cents. The company reported a 7.9% year-over-year increase in revenue, reaching $6.97 billion, surpassing the consensus estimate of $6.70 billion. Southern's strategic focus on renewable energy projects and its diverse energy portfolio, including natural gas distribution, positions it well for sustained growth. However, the stock's P/E ratio of 24.12 and a dividend yield of 3.2% suggests that while it remains a stable investment, market participants are pricing in moderate growth expectations. The strategic moves by institutional investors and Southern's consistent dividend payouts underscore its appeal as a reliable income-generating asset in the utilities sector. The company's guidance for the remainder of 2025, with an EPS range of 4.20 to 4.30, suggests confidence in its operational capabilities despite broader economic uncertainties. As the utilities sector continues to evolve, Southern's ability to adapt and expand its renewable energy footprint will be crucial in maintaining its competitive edge and delivering shareholder value.